Hi there. My name is Moshe Malevsky. I am a finance professor at the Schulich School of Business in Toronto, and I am also the CEO and president of a software company called the Quima Group, which develops algorithms, intellectual property, software around the area of retirement and retirement income planning. And what I'd like to do today is to share with you some examples of how that software works, and specifically to go through a series of case studies so that you can understand how specifically the output from those examples and the output from those case studies can help individuals with their retirement income planning. So let's get started. We're going to talk about a couple called Jose and Maria. Jose is 72 years old. Maria is a little bit younger. She's 65. And they are contemplating retirement, and they're going to be the basis of our 10 case studies that we're going to look at over the next few minutes. And right now, Jose has approximately $1 million sitting in his retirement plan. Together, they own about $1 million. Their nest egg is worth $1 million, but they have absolutely no pension. They have no source of guaranteed income, and the dilemma or the challenge that they face is how to ensure that this $1 million that they have lasts for the rest of their life. Remember that Maria, who's 65 years old, is in relatively good health, which means that there's a very strong chance that she's going to live into her 90s, possibly 100. In fact, according to the statisticians, there's about a 50% chance that Maria will make it to the age of 90. There's about a 25% chance that she's going to make it to 95, and perhaps even a 10% chance that she makes it to 100. So we have to ensure that this plan that we build for Jose and Maria is sustainable for the very, very long run. They may end up spending 35, possibly even 40 years in retirement. So let's go to the case studies directly. Let's start with case number 1. Recall that they have about $1 million invested, and right now, let's assume that 60% of this is in the stock market, and about 40% is in the bond market and fixed income products. If history is any guide, a portfolio that's allocated 60-40 between stocks and bonds is expected to grow over time and certainly beat inflation. Our estimates is that it'll beat inflation by about 4.8% every single year. Some years by more, some years by less, but in the long run, on average, this portfolio should grow by about 4.8% real. Now let's take a look at their spending. Let's start with a relatively high number. Let's say that Jose and Maria want to withdraw $70,000 from their portfolio every single year, adjusted for inflation, real $70,000 in today's dollars. Do you think that's a sustainable standard of living? Is $70,000 too much to withdraw from a portfolio starting at the age of 65? Well, if you input these numbers into our algorithms, we find that if this is what they do, there is a 45% chance that their plan will fail. 45% chance that they will not be able to withdraw this for the rest of their lives, and at some point, the money is going to run out. If there's a 45% chance of failure, it means that the success is only 55% of the time. We like to call it the retirement sustainability quotient. The RSQ is only 55%. This is not very good, so let's now take a look at another case in which Jose and Maria reduce their spending. So let's assume in case number 2 that they still have their same asset allocation, 60% stocks and 40% bonds, but now they reduce their spending from $70,000 per year to $55,000 per year. Let's say they reduce their spending by $15,000 a year. Now remember, the $55,000 that they're spending is again in inflation-adjusted terms, real dollars, today's dollars. When you input these numbers into our algorithm, now we find that the failure rate is actually reduced to only about 26%, not the 45% that we had in the previous case. The sustainability quotient is about 74.3%, better than what we had in case number 1, but still not great. In fact, the legacy value of the portfolio, the amount that Jose and Maria expect to leave to their kids in present value terms, is about $200,000. So, if you reduce spending to $55,000, this is what the outcome is going to look like. Let's take it a third case. In case number 3, the portfolio asset allocation is still 60% stocks and 40% bonds, but now let's imagine that they reduce their spending even further to $45,000 per year. Think about it, from 70 to 55 to 45. What do you think happens to their sustainability quotient if they reduce their spending even further? And as you can imagine, the sustainability quotient that comes out of our analytics is about 86% now if their spending is only $45,000. The legacy value is higher as well. They can expect to leave more to the children in present value terms because they're spending less. The legacy value is going to be about $339,000. In fact, these 3 cases that I just discussed can be plotted on a graph that trades off sustainability and legacy. Take a look at the chart. On the x-axis of this chart, on the bottom of the chart, you will see the retirement sustainability quotient, or the RSQ for short. Notice that the farther out you go, the higher the sustainability. Likewise, in the y-axis, if you move up, you get higher legacy values or financial legacy values. Let's take a look at case number 1. What happened when Jose and Maria were spending $70,000 a year? Recall that the sustainability was quite low and the legacy value was close to 0. As Jose and Maria withdraw less, you will notice that the sustainability value of their plan increases, their RSQ goes up, because they're withdrawing less from the portfolio. But at the same time, the legacy value is increasing as well. And when they reduce their spending in case number 3 to $4.50 per hundred, that was the $45,000 per million, the sustainability value is even higher and the legacy value is even higher. This is the single most important trade-off that people face in retirement. The sustainability is going to have an impact on the legacy value and vice versa. If they want more sustainability, one of the things that they can do is reduce their spending. If they want to have greater legacy value, one of the things that they can do is reduce their spending. Every product mix, asset mix, strategy, or plan that you have for retirement can be plotted on this frontier. And I will show you a few more examples of how different product allocation strategies will impact this picture. So far, you've seen what happens to the couple's sustainability and legacy value if they move their spending up and down, if the lever that they have under their control is spending. Now let's go beyond spending. Let's take a look at how the legacy value and the sustainability of their portfolio changes if they actually take some of their money and they pensionize it. What does it mean to pensionize? Pensionize is a process of taking a part of your portfolio and giving it to an insurance company so that they can pay you for the rest of your life. It's like buying a pension if you don't have one. What if Jose and Maria take some of their nest egg and pensionize it? So let's take a look at case number 4. They still have 60% of their portfolio in stocks and 40% in bonds, which is the same growth rate of about 4.8% after inflation. And let's assume that they want to pull out $45,000 per year, as we had in case number 3. But now let's assume that Jose and Maria take 10% of their nest egg, $100,000, and they go to an insurance company and they purchase an annuity, a single premium immediate annuity. That annuity will promise to pay them about $5,000 for the rest of their lives, just like a pension. And that pension will be inflation adjusted. It'll keep up with the cost of living. What happens to Jose and Maria's RSQ and legacy value? Well, let's think about this carefully. If $100,000 has just gone out of the portfolio to purchase the annuity, that leaves about $900,000 to cover the remaining expenses of about $39,000 a year. When we put these values into our algorithms, we now find that their RSQ value is even higher at about 89%, but their legacy value is reduced to $319,000. Why did the legacy value go down, but the sustainability go up? That's the nature of pensionization. You take money out of the estate, but in exchange, you get a greater guarantee, more income for the rest of your life. That is the fundamental trade-off that I mentioned earlier. Just to make sure that you understand this, let's take a look at another case, case number 5. Let's imagine that they have the same asset allocation and the same spending rate, but they pensionize 20% of their nest egg. They take $200,000 to buy the annuity. That leaves only $800,000 for investment purposes. Run those numbers through the algorithm, the RSQ value gets even higher. It's about 92%. But the legacy value is reduced even further to about $299,000. The more security you create for yourself, the less legacy you create for the next generation. In fact, in case number 6, if you pensionize 30%, you can increase the sustainability value to about 94%. And in case number 7, if you pensionize 35% of the nest egg, we can get the RSQ value to about 95%, but the legacy value is reduced. Do you see a pattern here? Let's take a look at that chart that I mentioned earlier again. You've seen this chart before, the sustainability versus the legacy value of a plan. Remember that the less you spend, the more the sustainability and the greater the legacy value. But what if you pensionize a fraction of your nest egg? How does that impact sustainability and legacy values? Well, take a look. If you pensionize 10% of your nest egg, your sustainability value will be greater than if you don't pensionize any portion of your nest egg, but your legacy value will be lower. As you pensionize a greater fraction of your nest egg, as you irreversibly hand over that money to the insurance company in order to create a personal pension and to generate income for the rest of your retirement, the legacy value is going to be reduced. Notice, as you move down the chart, greater pensionization improves the sustainability at the expense of legacy. So where should you sit on this frontier? Should you only pensionize 10% in order to have a greater legacy value? Or should you move closer to 35%, lower the legacy value, but increase the sustainability? This is your choice, and this is Jose and Maria's choice. This, once again, is the most fundamental decision, the trade-off that people face at retirement. Do you want greater security for yourself at the expense of legacy value, or do you want to create a greater legacy at the expense of security for yourself? As you pensionize more, you move down this frontier, higher sustainability and lower legacy value. Just to make sure this concept is clear, I'd like to go through 3 final case studies for Jose and Maria, just to make sure everybody understands this trade-off between legacy and sustainability. Let's imagine now that Jose and Maria change their asset allocation. Up until now, all the cases had 60% stocks and 40% bonds. Let's say they get a little bit more aggressive with their asset allocation. Now, you might say that at retirement, they shouldn't be doing that. Retirement may not be the time to get more aggressive with your investment portfolio. But remember, if Jose and Maria pensionize a fraction of their nest egg, they actually create a guaranteed source of income. Maybe they can afford to take a little bit more risk. Let's see what the analytics tell us. So let's imagine that they have 70% stocks and 30% bonds, which is now expected to grow by slightly more. It's going to beat inflation by about 5.1% in the long run. Let's say that they spend the same $45,000 per year, which was from the previous case studies, and they pensionize 35% of their nest egg. Remember, that means that they're going to get about $19,000 for the rest of their lives, inflation adjusted. That's what they get in exchange for their $350,000 that they've spent on an annuity. That $19,000 that they're going to be receiving will cover about 43% of their expenses. That leaves $650,000 in their portfolio to cover the $25,000 that they need to reach their retirement withdrawal rate. what happens to their RSQ value and their FLV value, their legacy value, now that they're taking a little bit more risk? So in this case, with a little bit more risk, 70% in stocks versus 60% in stocks, the sustainability value of the portfolio remains roughly the same at about 95%, which is very high, because of the fact that they have the pensionized income, but the legacy value is actually increased. Even though they've annuitized or pensionized 35% of their portfolio, they still leave a legacy of about $275,000 because of the fact that they have a little bit more risk. The portfolio grows at a slightly higher rate relative to inflation. Just quickly, let's go through two final cases just to make sure you understand the intuition and the trade-off between legacy and sustainability. In case number 9, we're going to dial up the risk in their portfolio to 80% stocks and 20% bonds. This is much more than the 60-40 that we had earlier on. We pensionize 35% of the portfolio, and the remaining $650,000 is allocated 80% stocks and 20% bonds. Now the RSQ value still stays at roughly 95%, but the FLV value increases even further to about $280,000. Do you think that they should go to even higher equity allocations? Well, case number 10 starts to tell us what happens if they go too far into equity exposure in retirement. The final case number 10 has 90% in stocks, 10% in bonds, which is a very aggressive portfolio for a retiree. It's expected to grow by about 5.7% after inflation, but there's a lot of fluctuation in that growth. They still spend $45,000 per year, and they still pensionize 35%, just like in the previous cases. But you'll notice now that the RSQ value is starting to creep down just a little bit. Even though they have 35% of their nest egg allocated to a product like a pension, the RSQ value is actually declining. The expected legacy value may be going up, but the RSQ value has gone down. And why is that? Well, think back to the chart you saw earlier. Taking on more risk might actually reduce the sustainability of the portfolio because something can go wrong. And if something does go wrong early on in retirement, there's a greater chance this portfolio is not sustainable. We've gone through about 10 case studies here, and I'm sure you have many other case studies you'd like to try. If you want to input your own case study, your own scenarios, your own parameters, feel free to go to our website, www.quima.ca, where we have a tool you can use to test out many different scenarios. Thank you very much.